Hello friends. Today, let's look at Apollo Tyres Limited, one of India's leading tire manufacturers, making tires for cars, trucks, buses, and two-wheelers. Here is what their financial story reveals. If we observe the sales 10 years ago, Apollo Tyres made 13,412 crores in sales. This year, that's grown to 26,349 crores. That is 7% growth every year on average over a decade. Moderate, but steady. The last 5 years saw 10% yearly growth, and the recent year grew 3%. What's interesting is the pattern. Some strong years like 20% growth in 2022 and 17% in 2023, followed by slower periods. This shows cyclical growth, tied to auto industry cycles and economic conditions. Not erratic swings, but definite ups and downs. Expenses climbed from 11,524 crores to 22,819 crores this year. Material cost: rubber, carbon black, steel make up about 50 to 60% of expenses. These fluctuate with commodity prices. Manufacturing costs are steady at 6 to 7%. Employee costs range 11 to 15%. Other costs stay around 10 to 13%. Apollo manages cost well, but raw material price swings to impact margins. Operating profit grew from 1,888 crores to 3,530 crores now. The operating margin is 13%. So, for every 100 rupees in sales, 13 rupees is left after direct costs. Margins have ranged from 11 to 18% over the years, showing the cyclical nature of the tire business. Other income was minus 422 crores. This includes some losses or write-offs, showing that side operations didn't help much this time. Interest costs are 440 crores, reflecting borrowing for expansion. Depreciation: the cost of machinery and plants wearing out is 1,506 crores annually, significant for a capital-intensive manufacturing business. Let's look at net profit. Net profit was 1,005 crores 10 years ago, and now it is 832 crores this year. That's actually 2% decline over a decade. Profits haven't grown with sales due to higher cost and competitive pressures. The recent years saw minus 27% profit drop, showing the challenging environment. EPS dropped from 19.94 rupees to 13.10 rupees this year. Not great for shareholders over the long term. Return on equity is 8.61%. Return on capital employed is 11.4%. Decent, but not outstanding for a manufacturing company. Dividend payout is 28% of profits, with a yield of 1.04%. Reasonable income for shareholders despite profit challenges. If you observe the growth pattern, Apollo Tyres shows cyclical growth. Sales and profits move up and down with auto industry cycles, commodity prices, and economic conditions. When vehicle sales boom, tire demand surges. During slowdowns, both sales and margins get squeezed. So, overall, Apollo Tyres operates in a tough cyclical business where growth comes in waves. While sales have grown steadily, profits haven't kept pace due to rising cost and competition. The company pays decent dividends and has manageable debt, but investors need to be ready for the ups and downs that comes with auto industry cycles. If you invest in Apollo Tyres, expect a bumpy ride tied to India's automotive fortunes, not the smooth growth of defensive sectors. If this breakdown was helpful, subscribe to Wealth Growth Club and tell me which company you want next.